Yeah, I welcome all the students to my class. Yeah, we are going to deal with the course unit BBAA 1133, the financial accounting 1. Maybe so we can start with the materials that is on investment account. So first of all, so maybe we have already uploaded these handouts to your LMS, but we are giving you the learning objectives. That mean once you completing this course unit, what you should be able to. So then, so as you all know, the term investment is not new for you because everybody has an interest to invest their money for their returns. So in this connection, so we can deal with the investment account. First of all, so we can define the term investment. What do you mean by investment? Simply, we can define the term investment. Investment refers to the funds invested in the form of different types of securities. Maybe if you have the money in your hand, you can invest your money at the bank, or maybe you can invest your money at the stock exchange or whatever it is. But anyhow, if you invest your money, so then it is desirable to keep the separate account for each security because you can simply identify the profit or loss that is on the transaction relating to the particular investment. So for this purpose, the firm should keep an investment ledger in which a separate account that can be opened for each type of investment or security. So this account may provide for columns regarding the date, face, value, interest or dividend and principal amount of securities. That means to open the investment account, you all can imagine maybe that would be a ledger, but these investment accounts will have the two sides, the debit and credit. Generally for all ledgers, so the date and description that is common. But in addition to that, we will have three major columns. That is number one, the nominal value. Second one, income. That may be in terms of interest or dividend. Third one, the capital value. So these three columns would be available in both sides. So that is the investment account. Then we can see later with an example. Then when we deal with the investment account, we have to clearly understand the two different terms. One is the cum dividend or cum interest. Second one, ex dividend or ex interest. So then we can see what is cum dividend or cum interest. So if the investment price is determined on the basis that when we purchase the investment, interest on securities or dividend on charge for the next period is payable only to the purchaser. So that will be called as cum dividend or cum interest. For the cum dividend purchase or sales, the interest or dividend for pre-acquisition period should be adjusted. So that means maybe if you purchase the investment cum dividend, then we should adjust the interest for the pre-acquisition period. So that should be made through the investment account. So that part we can see later. Same time, yeah, we can think about what is that ex dividend or ex interest. Maybe if the price is determined on the basis that regarding the investment purchased, interest on dividend for the next period is payable only to the vendor. You know that if the cum dividend, that is payable only to the purchaser. If it is ex dividend or ex interest, that should be payable only to the vendor. So that will be called as ex dividend or ex interest. Maybe in case of ex dividend purchase or ex dividend sales, we should adjust the interest for the post period. That means the post period purchase or post period sales interest should be adjusted and recording should be made through the investment account. So keeping all these informations about cum dividend and the ex dividend, then we can move to the accounting treatment. You know that the financial accounting for each and every transactions, you can think about the double entry. So according to the double entries, you can start to do the entry in the necessary ledger box. So then accounting treatment. So when we purchase the investment account, the double entry would be the investment account debit, bank account credit. If you sell the investment, that means double entry, the bank account debit and investment account credited. At the same time, if we invested our money in different investment, from that investment, we will get the returns in terms of interest or dividend. So whenever we get the income from the investment, the double entry would be the bank account debit, investment account credited. So the investment account credited means that will be recorded in the credit side of the investment account, that is within that income column. So this is the accounting entries for the investment. So then, having the more understanding, so we can move to the example number 1. I think you all have this example in your handout, which is available on your LMS. So a company bought 50,000 12% loan stock on 1st September 2018 at 94 cum interest. Interest is payable half yearly on 30th June and 31st December. So then you are requested to show the entries in the investing company's ledger book for its financial year ended 30th June 2019. So then we can see how we can deal with this accounting entries in the investment account. For your easy understanding, in my prepared PowerPoint slides, the answer is available. So first of all, you can see on 1st September 2018, the company purchased 50,000 12% loan stock at 94 cum interest. So then what we do, this is the purchase of investment. The double entry would be investment account debit and bank account credit. So then if you move to this investment account, first of all, you have to put the heading for this account, that is investment account, and this is the 12% loan stock. It is invested on 12% loan stock. So now you can see this investment account in each side, debit and credit side. There we have the date and description that is common for all the ledgers. But then we have the nominal value, income, and capital in each side. First of all, so we purchased the 50,000 investment on 1st September. So then in the debit side, we will put the date 1st September 2018. The description by bank, 50,000 is the nominal value. 50,000 is the nominal value, but we had to compute the capital value. How to compute the capital values? We should see at what price each investment document was purchased. In this example, it is clearly given it is purchased at 94 cum interest. If the price is closer to the 100, that means the each investment document value is 100 rupees. So then you can simply understand 50,000 rupees investment was purchased. So then 50,000 divided by 100, that means altogether the 500 loan stock was purchased. Then how we can compute the capital value? The 500 into 94, we will have 47,000. But if you see this solution, so 46,000 is not recorded under the capital column, because this is purchased cum interest. So theory clearly says if it is the cum interest purchase, the pre-period interest should be adjusted. But that it was purchased on 1st September, then we should understand the before this investment, what was the last date that interest was calculated. You know that interest is payable half yearly 30th June and 31st December. So then if this investment was purchased on 1st September, so the last interest was calculated on 30th June 2018. So then from that 30th June to 1st September, we had to see how many months. So then August and September, only 2 months. For the 2 months, interest should be calculated. How to calculate the interest? Nominal value. Nominal value 50,000. The interest rate is 12%. So then 50,000 divided by 12 upon 100. But then we had to compute the interest only for 2 months. No? Then into 2 upon 12. So that means if we compute the interest for the pre-period that is only for 2 months, that interest would be 1,000 rupees. So then that 1,000 rupees included into the total capital value of 47,000 rupees. So that 1,000 rupee should be debited to the income column, and the remaining 46,000 is debited to the capital column. So this is the entry. So finally we can see what the entry we have done for the purchase of investment. So it is debited to the investment account, 50,000 in the nominal column. So income 1,000 rupees and capital value 46,000. I think you all have understood this one. So then we can think about, on 1st September 2018, so investment was purchased and entry was done. So and what is next? We don't have any more transaction, but we had to close the account on 30th June 2019. That means, you know that accounting financial year that is starting from June or July and ended on June. So then if we purchase this investment on 1st September, we have to think about what is the next date of interest calculation. So then the next date of interest calculation would be 31st December. Then we have to check whether we should compute the interest on 31st December or not. So we can see this is investment purchase cum interest. If the investment purchase cum interest, that interest should be payable to the purchaser. So then we should compute on 31st December 2018. If we compute the interest for the 50,000, 12%, that is 6,000, that is for 1 year. But then we had to compute it for 6 months. So 3,000. So again, what we do, the 3,000 interest, for that 3,000, we had to make the entry. So what is the double entry? The bank account debit, investment account credited. So that is what in the credit side, date 31st December 2018, description bank, within bracket, it is put as interest. Then 3,000 interest should be recorded under the income column. That is on 31st December. But anyway, so we had to close the account on 30th June 2019. So then after 31st December 2018, what is the next date of interest calculation? That should be on 30th June 2019. So again, we should compute the interest on 30th June 2019. You know that will be the same amount of 3,000. So bank account debit, investment account credited. So it is recorded under the income column in the credit side of investment. Then we don't have any more transactions, so we can close the account. If we close the account, you know that in the debit side, we can close nominal value and the capital value. Nominal value 50,000, capital value 46,000. Then we can get the balance in the credit side, 50,000 and 46,000. Maybe you know that on 1st July 2019, it should be debited to the investment account as balance brought forward. Nominal value 50,000, capital value 46,000. That's all. But at the same time, so we should see the income column. Maybe we had to see the credit side. Altogether 6,000 we have. Then that 6,000 is transferred to the debit side. If we look at the debit side, already we have recorded 1,000 rupees. So then we will have the balance 5,000. So that means the remaining 5,000 is transferred to profit or loss account. Profit or loss account. So this is the accounting entries for this investment transaction. So here the important note is given for you for your easy understanding. So when securities are acquired, ex dividend or ex interest, the amount of dividend or interest by which the buying price has been reduced is debited to the capital column and credited to the income column. And the whole of the purchase cost is debited to the capital column as well. So that we can see it with the example number 2. Yeah, with the example number 2, Sadhu Limited bought 50,000 12% loan stock on 1st December 2018 at 91x interest. Interest is payable half yearly on 30th June and 31st December. Show the entries in the Sadhu company's ledger for its financial year ended 30th June 2019. So then we can move to the accounting entries. The first one, on 1st December 2018, 50,000 investment was purchased at 91. So we will do the entry. What is the entry for the purchase of investment? Investment account debit and bank account credit. So then we will debit it to the investment account, the date on 1st December 2018, description bank, the nominal value 50,000. But then capital value we should compute it. It was purchased at 91. So how do we compute? 50,000 nominal value divide by 100 into 91. Why we divide by 100? If the purchase value per loan stock is 91, which is closer to the 100, we assume the per loan stock value is 100. So then 50,000 divided by 100 into 91, the total capital value would be 45,500. So that should be debited to the capital column. But before recording that 45,500 into the capital column, we had to check whether this investment was purchased cum interest or ex interest. If it is cum interest, we should adjust the pre-period interest and remaining amount should be debited to the capital column. That is what we have seen in the first example. At the same time, if the investment is purchased ex interest, so we don't need to worry about this straight away. We can put the calculated capital value under the capital column. So then 45,500 is debited to the capital column. Then as per the theory, so you have to start to think, what is that? So if it is ex interest, you know that the post period interest should be adjusted. That means it was purchased on 1st December 2018. So then interest is payable half yearly on 30th June and 31st December. So then if investment is purchased on 1st December 2018, what is the next date of interest calculation? That is 31st December 2018. So then from the date of investment purchased 1st December 2018 to 31st December 2018, that is only for 1 month. Then we should compute the interest for 1 month. How do we compute? So nominal value is 50,000. So 50,000 into 12%, 12 upon 100. Then we had to compute the interest for 1 month into 1 upon 12. So we will have 500. What is that? The investment value, the capital value was reduced by this interest. So that is what we should do. That 500 should be debited to the capital column and credited to the income column. So then you can see this solution. So on 1st December 2018, 500 is debited to the capital column, the description income. At the same time, that 500 is credited to the income column with the description of capital. Right? So that's all. But then in the same example, we don't have any more transaction, but we had to close the account on 30th June 2019. So then we had to compute the interest. So you can clearly observe this example. This investment was purchased on 1st December 2018. So then what is the next date of interest calculation? That is 31st December 2018. But we had to check whether the investment was purchased cum interest or ex interest. This investment was purchased ex interest. Ex interest means the immediate next period interest is payable only to the vendor, that means seller, not to the purchaser. Now we are maintaining this investment account in the purchaser's book so that on 31st December 2018, we don't need to compute the interest because this investment was purchased ex interest. But don't understand, if the investment was purchased on a particular date, even in the post date, there's no any interest for the purchaser. That is wrong. If you feel like that, then we don't need to invest our money in different investment sources. That is only for the immediate next period, the purchaser is not eligible for the interest. Okay, but then after 31st December 2018, then we can see what is the next date of interest calculation. Yeah, that is 30th June 2019. 30th June 2019. So then 30th June 2019, the purchaser, investor is eligible for the interest. So we can compute it. So if you compute the 12% interest for 50,000, 6,000, that is for 1 year. But we had to compute the interest for 6 months because the interest is calculated on 6-month interval. So then we will have 3,000. As you all know, the double entry would be for this income, bank account debit, investment account credited. So then it is credited to the investment account on 30th June 2019 with the description bank. 3,000 is recorded under the income column. That's all. As we don't have any more transactions, so we can close the investment account. As how we close the investment account in the example number 1, you can close this investment account. Then you will have the balance carried forward. Nominal value 50,000, capital value 46,000. At the same time, income column, in the credit side, totally 3,500 we have. That is transferred to the debit side. But in the debit side income column, there is no any entry. So entry 3,500 is transferred to the profit or loss account. So with that, we can finish this example. So I think you all have a clear understanding about these accounting entries for the investment purchase, cum interest and ex interest. Then we can move to the next part, that is investment sales. Maybe we can sell the investment cum interest or ex interest. So dividend or interest sales. What is that? The cum interest. When the securities are sold, cum dividend or cum interest, the accrued dividend or interest element is credited to the income column. And the balance being capital proceed is credited to the capital column. You know that what we did in our previous example for the investment purchase cum interest, whether it may be the purchase of investment or sales of investment, if it is purchase or sales sold cum interest, the pre-period interest would be adjusted. So we can simply see the example number 3, then you can understand it. So what is this example number 3? The RAM company has 50,000 12% loan stock on 1st July 2018 at a value of 45,000. On 1st September 2018, company sold it at 94 rupees cum interest. Interest is payable half yearly on 30th June and 31st December. Prepare the ledger account in the books of RAM. So we can see this. You know that on 1st July 2018, RAM company has 50,000 nominal value of loan stock at a value of 45,000. So this is not purchased in the same year. It has already been purchased and the company has the balance. So then when we move to the investment account solution, what we do, we will record for this amount as the opening balance. That is on 1st January 2018. It is debited as balance brought forward. What is the nominal value? That is 50,000 is recorded. And capital value 45,000. For this opening value, opening balance, we don't need to see whether it is a cum or post, because we don't need to adjust the interest. So that is what we will make the entry in the debit side as the opening balance, 50,000 nominal value and capital value 45,000. But then what is that? Company sold it at 94 cum interest on 1st September 2018. So the company had the balance on 1st July 2018, but then it was sold on September 2018. It was sold at 94 cum interest. So you know that. So what would be the double entry for the sale of investment? The bank account debit, investment account credit. So what we do, we will make the entry at the credit side of the investment account. On 1st September 2018, bank description, nominal value 50,000. Capital value we should calculate. This is 94. Then how do we compute? 50,000 divided by 100 into 94. So then we will have the amount 47,000. But before recording that 47,000 at the capital value, we had to check whether it was sold at X interest or cum interest. So it is cum interest. If it is cum interest, the free period interest should be adjusted and that amount of interest should be reduced from the capital value. But then if it is sold on 1st September, so what is the previous date of interest calculation? That is 30th June 2018. Then how many months in between the sale of investment? You know that is July, August, 2 months. So if we compute the interest for 2 months on 50,000 nominal value, that is 1,000. So that 1,000 is credited to the income column, and that 1,000 is reduced from total calculated capital value of 47,000. So remaining 46,000 is credited. You know that what we have done in the debit side for the purchase of investment cum interest, the same lines we will make the entry for the sales of investment cum interest, but in the credit side. Okay. Yeah. But then we all have to be very clear and careful. If the purchased investment is sold at any date, because of that sale of investment, the company can have profit or loss. So then we had to compute the profit or loss on disposal, that is the sale of investment. Clearly we can identify what is that. Maybe this debit side, the capital value 45,000. That means this is the cost of investment. But in the credit side, we can identify the sale of investment, 46,000. So that means you can simply understand the 45,000 cost of investment has been sold to 46,000. So then if the 45,000 cost of investment is sold to 46,000, the different 1,000 rupees would be considered as profit. But the double entry for the profit on disposal, investment account debit, profit or loss account credited. So that is what it is debited to the investment account on 1st September 2019. Profit on disposal 1000, that should be recorded under the capital value. You know that if you have the profit on disposal, that is investment account debit, profit or loss account credit. If you have the loss on disposal, profit or loss account debit and investment account credit. Okay, now we have made the entry for the opening balance and the sale of investment. But then what we can do? It is sold on 1st September 2018. That means entire investment has been sold. Cum interest. If it is cum interest, for the immediate next period, the interest will not be eligible for the seller. So now we are the seller. So then, if the investment has been sold fully at cum interest, so then we don't need to compute the interest on this investment account. So then we can close it. If we close it, we will not have any balance because entire available investment has been fully sold. But at the same time, we had to see the income column. Credit side, that is 1000, but in the debit side, it is not available. So then that 1000 rupee should be transferred to profit or loss account. So here I have written profit or loss account, but 1000 rupees not entered under income column, but you had to record 1000 rupee in the income column. That's all. Then we can think about the ex-dividend or ex-interest sales. Maybe you know that when the securities or investments are sold ex-dividend or ex-interest, the amount of dividend or interest by which the selling price has been reduced is debited to the income column and credited to the capital column. The whole of the net sales proceeds are credited to the capital column as well. You know that if the investment is sold ex-interest, then we had to compute the interest for the post period. So that post period interest should be adjusted. For that one, we had to make the entry. So we can clearly see the accounting entries with example number 4. RAM Limited had 50,000, 12% difference on 1st July 2019 at a value of 45,000 rupees. Interest is payable half yearly. On 1st December 2019, company sold this investment at 91 x interest. So you are required to prepare the investment account in the books of RAM Limited for the year ended 31st December 2019. So first of all, what we can do, because on 1st July 2019, RAM Limited had the opening balance. So we will make the entry. What is that? In the debit side, on 1st July 2019, balance brought forward, opening balance, nominal value 50,000, capital value 45,000, that is given. Then what we do, on 1st December 2019, company sold this investment. The entire investment has been sold at 91 x interest. So then what is the double entry for the sale of investment? Bank account debit, investment account credit. So then we will credit to the investment account the 1st December 2019 bank description, nominal value 50,000. But this 50,000 investment was sold at 91 each. So then we will compute the capital value 50,000 divided by 100 into 91, that is 45,500. That 45,500 can be recorded in the capital value because this was sold X interest. But at the